Welcome to this episode number 109 of Your Next Trade, called today Big Beautiful US Market. So this week we had a shorter week due to the 4th of July, so only 4 days of trading in the US and pretty quiet in Europe despite the market going lower. But the big news obviously for Thursday and Friday was the big bill that was voted in the US and gives a huge relief for the next 4 years in terms of GDP growth, earnings growth, anything that is growth. So on one hand, you can argue that it's very good for growth. On the other hand, that doesn't solve anything about the deficit, the US deficit. If you think about what is happening these days, you have a US economy that is growing between 1 to 3%, so it's still, growing pretty nicely. But in the meantime, the US economy is experiencing a 6 to 7% deficit. So if you think about it, normally those kind of deficits will be happening when you have a recession. And you can argue that this is the same for most countries in the world. This is the same in Europe, same in Japan. So everyone is doing the same. We are kicking the can down the road. We are not trying to solve what is the deficit. And if you're going to be making tax cuts, if you're going to be increasing some of the part of the economy, obviously you're going to have growth, but in the long run, this is unsustainable. And obviously, as we said in the past, that has huge effect for the debt and how we're going to be dealing with the debt going forward. But let's cheer. This is a positive for the US economy, at least in the short run. The market really, for the time being, is looking at this. If you look at the banks, as we flagged again and again, they are making new highs due to growth going forward, the regulation. So it's almost like, let's be making money in the short run and we're going to be caring about, the outcome and in the long term. So let's look at the week to date asset performance. So this is at the end of Thursday. So even if the other markets were open, I just wanted to make sure that it was over the last 4 days. So the market making new highs. We are talking S&P and the Nasdaq roughly up 1.6 to 1.7%. As you can see, and this is something that we flagged quite recently, that the odds of the Russell, the small and mid caps, are performing, and that has been the case. So it is broadening to the other part of the US economy. Why? One of the reasons, obviously, if you look at the Russell 2000, this is mostly companies that have exposure to the US, not much about exports, and they have been doing much better. Why? Because this bill is going to be helping US companies. US dollar pretty much flattish. Bitcoin, we're going to be talking about it later, so stay with me because there is an important trigger that's going to be happening in the next couple of weeks. Gold, WTI, copper behaving pretty much the same. I want to switch into the week to date industry performance, something that we discussed. So looking at what is outperforming, this is regional banking, banks. Why? Again, deregulation, growth coming. We flagged the all-time high and the breakout of JP Morgan not so long ago, and this is the confirmation. Similar, as you can see here, software, airlines, still. So you're gonna see some sectors, the cyclical sectors, that are outperforming the overall market. S&P 500, that is only here. So as you can see, many sectors outperform the overall market for this week. On the left hand side, health insurance, where insurance is mostly with the Medicare, Medicaid. That's going to be experiencing some cuts, and that's bad for the industry. I want to go into the sector performance. As you see here, materials doing very well, up 4% over the last 4 days. So very strong. And that tells you that, again, that the growth going forward is going to be pretty good. Technologies as well, good as usual. Financials, pretty good, and the defensive like telco, utilities, consumer staples a bit underperforming the overall market. Switching into rates, so now we got the US 10 years at 4.35. So pretty much the same story. We're going to be talking about fiscal dominance pretty soon. That's going to be in 5 minutes, and explaining what is happening due to the deficit going forward. Fed funds rate, so looking at the next FOMC meeting, so we should be looking at this one. As you can see, the odds of the FOMC doing something at the end of July are coming pretty low. We are talking almost no chance. We are talking 10% chance that the Fed is going to be cutting. Now we are looking more into September meeting, where the odds are around 80% for the Fed to be cutting. Why? Because the NFP numbers were pretty good on Thursday, but we do have like the CPI comings at the let's say mid-July, and that's going to be a big number. So conflicting numbers, but overall the trajectory is the market saying, you know, no cut in July. What about the VIX? So volatility 17.5% for the 30 days, 12.8%. So volatility has been coming lower. As we explained, as most recently, both the realized and the implied volatility due to the expectations of better growth going forward. And as well, we are in a sweet spot in terms of seasonality, and as well sweet spot due to less volume, and most of the time this less volume is making the volume control the funds that are selling volatility in charge of the overall market. So let's switch very quickly into the technical analysis, because the picture is more or less the same. So I like to call it the dodgy technical analysis. There is maybe a bit of level here around the 6300 level for the S&P futures, but pretty much since the breakout we have been going one-way traffic. So this is for Friday. Here the volume is almost irrelevant. So it's almost like, you know, people trading on over the weekend. That is completely irrelevant. I want to flag the Russell 2000, because, you know, that has been a big mover. We discussed here during the Euronext trade, and as well in the Discord community, that the 2130 was a big level, and since then we have been going up 4 to 5%. So pretty big move. Another one, JP Morgan. Every single week I'm going to be talking about it, as long as the picture is the same. We are not talking any crypto stocks, any stable coins, any energy, nuclear stock. This is JP Morgan, the biggest bank in the world, and as you can see, we flagged it at 277 because we had actually the dividend in between, but the stock has been one-way traffic. So we had the regulation that is coming. We have as well the stress test 10 days ago. That was pretty good, and more or less saying to the banks, you can have higher dividends, you can have higher buybacks, and that tells you what is the trajectory. So as long as the banks are so strong, it's almost impossible for the market to go lower. We are talking stocks. Nvidia, similar picture, making new highs after the breakout. Pretty much, you know, if you go from one stock to another, this is what we're gonna have. I want to be flagging from time to time crypto, because Bitcoin has been interesting. You know, I'm looking now at the TA, and later we're going to be discussing about a big catalyst coming. So we have been trading between 100,000 and 110,000, so going sideways with less volatility recently. So my assumption is we're going to have a big move in the next few weeks, and I won't be surprised actually for this move to be higher. So I want to go back into what happened for the week, discussing what happened over the last 4 to 5 days. And as I said before, we have been in the same market regime where we are going higher. And here you see the NFP numbers, which were here. This is your NFPs, where we had roughly 150,000 job creation. So the path is the same that it was recently. We went down, and now we have been consolidating, going sideways. So creation around 150,000 roughly on a 3 to 6 months. So not that bad. So pretty good actually, and in the meantime, that explained, you know, why probably the Fed is not going to be cutting at the end of this month. But I think what is very important is most recently the bonds duration or the fiscal dominance. What is fiscal dominance is, you know, normally what you have in emerging markets, where as you are running a big deficit, the treasury, the people that are emitting the bonds will be in charge, and not the central banks. And that means we have been moving the duration from long end into short end, and you are going to see more and more emissions of bonds, T-bills, should I say, anything that is less than 12 months. That means in the short term, that is good because you pay less, but in the long run, that means you're going into trouble. So most of the things that we are doing now, and I'm not only talking in the US, I'm talking Japan, I'm talking Europe, is kind of, let's enjoy this moment, let's enjoy those next 4 years, 5, 6 years, but then, trouble will be coming. So as always, that means earnings growth, good earnings growth, GDP growing, market going higher. But at one stage, and I don't have the timing, the market will say, that's it, we can't be moving more than this. I want to talk, as always, about price action and what has been leading the market. So on Tuesday, I think it was, we had a big reversal on the momentum stocks, so the high beta momentum. So the winners that keep on winning and have been very strong since the lows of April have been turning, and they were down 6% on the day. So a bit of a reversion, and as always, you need to be listening and saying, what is turning in the market? Is it a new regime coming? My view is the following: as we were coming into the earnings and just before the 4th of April of July. That means very often when you have big winners, if you are running a hedge fund and you get big exposure, you get big winners, you want to reduce gross exposure going into the earnings because you don't know what's going to be happening. So most of the time, at just before the earnings, and as we know that for this week, actually the volumes probably are going to be very low, you reduce exposure, and that means you look at your big winners, which is the momentum, and the hot money. I've been taking some of this money out of the table, but in the meantime, as you can see, the dodgy names, the liquid most short, the non-profitable tech, the most short rolling, we are talking high short interest, everything that is a bit dodgy was doing very, very well. So don't look only at momentum and saying, the market regime is turning. That is just not true. The not so great stories in terms of quality, I'm not talking about price action, in terms of quality, are still doing very, very well. So macro, we had the ISM manufacturing and services across the world. The picture is more or less the same. Both in the US and the rest of the world. NFPs, as I said, 150,000, so pretty okay numbers. Big beautiful bill, as we discussed, and we had the UK trouble. So I like to be on social media and look at social media because one of the things that traders love is to do some London bashing. 20 years ago, it was Paris bashing. It was all about the socialists. So I like it because I'm both French and British. And, this bashing about explaining to you that London is dead, that everyone is leaving. And, even when people are telling me they are going to Dubai, I say, hey, good luck to them. Go to Dubai. You're going to be making a fortune. So, and obviously, when you tell people that this is the end of New York, that this is the end of California, that this is the end of London, as an educator, you're going to be attracting all of you, those young traders in their 20s, thinking, oh yeah, he's right, this is the end, he knows. And I've been going that for years and years. Those same educators, 10 years ago were telling you this is the end of Europe, this is the end of Euro, this is the end of Deutsche Bank. So look at the chart of Deutsche Bank, you'll be laughing at it. So don't go for this thing. If you go for those things, you're still going to be in this 90% retail traders that are losing money. But this noise is always funny, and that attracts a lot of people and a lot of likes. But this is why we are still making money, because you're gonna have those idiots following those other idiots. So let's look at the catalyst for this week. Actually, not much happening. So yes, we do have like the tariffs deadline on Tuesday, but it's pretty hard to price those things. It's almost binary. So this is a big deadline. We are seeing more and more headlines of, deals happening, not deals happening. So rumors, not rumors. Is it going to be 3 months delay? I have absolutely no clue. You're going to have some bond supply. So you're going to have 58 billion here, 39 and 22. As I said, we're going to see more and more T-bills, meaning short-dated bonds. Not much into the earnings conferences. You do have like a bit on Thursday, but mostly it's starting on the 15th of July with JP Morgan. So keep a bit of energy, because on the 15th you're going to have actually the CPI. So that's talking about macro, and as well the earnings season starting. So talking about the earnings season, this is the chart that we have here. This is the S&P 500 Q2 EPS expectations. And as you can see, the expectations have been coming down massively recently. So until the end of May, this is the chart that you have. So since then, we have been trading sideways. But what you can argue is over the last 6 months, expectations have been coming much, much lower. And that means, as always, when those expectations have been lowered, it's much easier to beat the expectations. So I won't be surprised to see a lot of bits. As usual, we are talking the 75 bits for EPS or 60% for revenues, because, you know, not so long ago, we were talking $64.4. These days, it's roughly around $62.8. So if you think about it, this is, you know, $1.6, 2.5 to 3% lower of the expectations. And in the context of EPS, that is pretty significant. I want to talk, from time to time, we talk about crypto. And here, this is the IBIT, the number of shares. So IBIT is the biggest ETFs for crypto. For Bitcoin, we are talking 77 billion almost assets. And you can see the steadily number of shares that are created. So if you get these new assets where many investors actually don't have exposure, it's normal that if you go from 1 to 3% of your exposure to 5-6%, that slowly but surely, it's almost like a VWAP order where you say buy some Bitcoin for the next 12 months to increase my exposure. And this is what is happening. But we do have actually some catalysts on the 22nd of July or before, where we had the crypto reserve fund deadline. You probably remember that the Trump administration said, you know, we're going to have money dedicated through the crypto reserve fund, and there's going to be some Bitcoin, some Ethereum, and the deadline is on the 22nd. So we look at the charts, we look now at how the assets, how the flows are going, and we do have like a catalyst. So I won't be surprised to see big moves in the next few days, in the next 10 days in the crypto world. Finally, looking at the SPY weekly straddle, plus minus 1.4%. So as I said, volatility pretty compressed. In terms of macro, we don't have much. We have the NFIB. We do have like some red decision down under. We are talking Australia and we are talking New Zealand, where Australia, we are expecting 25 bips cut and not much change for the Kiwis. This is more or less what we have. So I'm going forward. So this is the summer, you know, I'm French, I'm pretty lazy. I'm not sure that I'm going to be doing those weekly videos going forward, at least for the summer. I'll see, it depends, you know, if there is some interesting stuff to discuss. This is for the week. If you got any questions about the mentoring, about, you know, the community, about how we can do one-on-one sessions together to improve your trading, your investing, give me or send me an email at greg@duponttrading.com. This is it for me for this week. Have a good trading week. Bye-bye.